Back here at home in the U.S., it has been a downward slope for the markets for the last couple of weeks. Our next guest says he's been cautious on risk assets. What are those assets just getting too cheap to pass up these days? We're joined for his take on what sounds like a bearish market outlook. Jeremy Zirin, Chief Equity Strategist for UBS Wealth Management. Jeremy, thanks for joining us this morning. You know, when we look at your forecast and then the broader market, the question comes in. We look at the biz cycle slowing down, you think. Yet when we look at the projections for corporate profits and for earnings season, estimates are being raised at the fastest rate since 2004. How do you reconcile that?
Yeah, overall, I think that we're going to start to see a pretty cautious guidance coming from the corporate sector in second quarter earnings season. And it looks to me that, 2010 earnings estimates probably are reasonable, but 2011 estimates seem overly optimistic for the second or third year of a recovery process when the markets are, or consensus bottom-up estimates are at over 20% growth for corporate profits.
So you feel comfortable selling ahead of earnings season right now?
Well, I think that, given the fact that the market has already pulled back 16% off its high, I think we're more likely due for a period of range-bound markets during the summer. Valuations, like you said, are getting to be at pretty attractive levels, but overall, the business conditions aren't great. We're starting to see leading economic indicators roll over. We saw one of our favorite leading economic indicators, the ISM Manufacturing Index, significantly disappointed last week with a 3.5 point drop. And the labor market conditions just aren't conducive to a real compelling story for why we have stronger growth in the second half of this year and into 2011.
So what are you buying?
We think at this point of the business cycle, it makes sense to rotate into the more defensive areas of the market.
Like pharma, or what in particular?
Our preferred defensive sector is consumer staples. We think consumer staples has the best combination of attractive valuation and core fundamentals. They sell to emerging market consumer, which has been largely unscathed and continues to grow as income levels grow in the emerging economies at the consumer level. So those big cap names and the multinational names in food and beverage industry, in the household and personal products industry all have nice dividend yields. They're growing their dividend, roughly 8 to 10% a year.
You're also overweight technology here, but if you believe that globally we are slowing down on the economic front, why do you think there still will be spending on technology?
I think, technology I would classify as more of a defensive cyclical. I mean, the technology infrastructure is a core part of a business and even an individual's purchasing. We also see that technology valuations are very depressed. Typically, the technology sector trades at a roughly 20% premium to the S&P. That premium has shrunk to about 4%. So we think that the market has just become overly pessimistic on the tech infrastructure spending cycle.
Are you going to stay underweight consumer discretionary even going into the back-to-school season?
Yeah, we actually just increased our underweight in consumer discretionary, and that's where we think that there's the most risks if we continue to see a disappointing labor market activity. The consumer discretionary sector is the second most expensive sector in the S&P 500. The sector had already had tremendous gains coming off the March 2009 bottom, and now we're really starting to see both earnings estimates roll over for the sector, and I think that the valuations are still high on a relative basis where there's still downside risk to that sector.
So quickly, we have to go here, but when you say underweight, what do you mean exactly? What portion of your portfolio?
So relative to the S&P 500 weightings, we have a 200 basis point underweight in the consumer discretionary sector and a 200 basis point overweight in the consumer staple sector. Those are our biggest tactical shifts that we have relative to the market index.
So you're just trimming. You're not out of it entirely. All right.
Exactly.
Thank you, Jeremy Zirin, Chief Equity Strategist at UBS Wealth Management, joining us this morning.